Nikki. So let me introduce Joe. A lot of you know him. He attends the climate workshop, book club. And so, as I said, a lot of you might already know him. But what he told me here, and I'll read it, is educated at Amherst and Harvard. He renounced his misspent youth in big law to spend his middle age founding and running green investment strategies, a wealth management firm dedicated to helping clients make responsible investments that can positively impact their portfolios and our one habitable planet. Invested wisely, private capital can help solve the climate crisis and create a better world for ourselves, our children, and everyone else's. Money talks. What does yours say? And I invited Joe to talk to us because I know a number of people are very interested in how they can responsibly make green investments. So I thought the best way to find out is to actually invite somebody who is involved with that field. Welcome, Joe, and we'll have a question and answer period when you're done, okay?
Thank you, Nikki. Thank you, everybody, for having me here. Well, I've been doing this for about 9 years. So what I'm going to try to tell you guys is what I wish I had known 9 years ago about how to invest intelligently during a climate crisis. And this is what we're going to do. We're going to very briefly talk about me because I don't like talking about me. We're going to talk about the problem, which is more important, focusing on sort of the heart of the problem. I'm going to try to prove to you guys that you can both do well and do good with your investments. And I'm going to give you some tips on how to do it. So that's me. I'm from a small working class town on the Jersey Shore. I went away to school. I got a job at a big law firm. I made some money. I invested the money. I became concerned about the climate crisis. And not because I'm a saint, because originally it was more about how is this going to impact my portfolio? Aren't there some risks here that we're not taking into account? I had a conversation with my financial advisor about it. He kind of looked at me like I had 5 heads. He said, "Let me get back to you on that." He came back to me and he said, "Joe, I found a fund for you, a socially responsible investing fund." And I said, "Great." And he gave me the name and I looked it up and I was like, the number 2 and number 3 biggest holdings in this fund are ExxonMobil and Chevron. And then I felt bad because I was like, I know this isn't really what you do. I'm asking you to do something that you don't really have particular expertise in. I was like, let me just figure this out on my own. And so I did. And figured out how to invest sustainably, figured out how to do that in a way that's still profitable. People started asking me for advice, started giving them advice about it. I decided I would get a little more education, formal education about it. This sort of gold standard degree is the CSRIC degree, which stands for Chartered Socially Responsible Investment Counselor. And I founded my firm 2 years ago. That's my firm, Green. We are a pending B Corp. We're legally a benefit corporation, which enables us to take into account more than just pure shareholder short-term profit. You can also take that into account, plus a broader spectrum of stakeholders. We give 1% of our money that we take in to 1% for the planet, which is environmental causes, environmental charities. We're active in the Sustainable Business Network of Philadelphia, which is what it sounds like. It's a group of local businesses that are committed to the triple bottom line of people, planet, and profit. I'm on the board of directors. There's some good people trying to do good with their businesses. So, okay, here's the problem. The problem is that 2024 was the hottest year in recorded human history. And because it was so hot, extreme weather caused $320 billion in economic damage last year alone. That did not take into account all the people injured, the people killed, the people traumatized. Add that on top of the pure financial damage. But at the same time, the weather's getting worse. The amount of money that's being invested sustainably in the United States decreased by 10.6 billion. And as those of us who are active in the climate change book club might suspect, a big reason for that decrease is fossil fuel propaganda. And if you look at the rest of the world, the rest of the world is increasing the amount of money that it invests sustainably at the same time as the United States is decreasing it. And that is because we're exposed to a lot of coordinated propaganda. All right, now, you may be saying to yourself, it's a big problem. What do I do about it? Well, you can focus on the core of the problem, which is that 70% of carbon dioxide emissions are the responsibility of 78 organizations. Some of them are corporations, some of them are nation states. If you want to expand that a little bit from a financial perspective, we keep track of what we call the Carbon Underground 200. So it's not just 78, it's the 200 biggest owners of fossil fuels in the world. And if you avoid those, this is my core message here, if you avoid those, you are moving in the right direction. And surprisingly, the impact of doing so is pretty big. If you just shift your retirement account to fossil fuel-free investments, it's a bigger effect on your carbon footprint than giving up flying, becoming a vegetarian, and powering your house and everything in it via clean energy combined. Which is to say, money is power. We should be using it in the right way, my opinion. So you might think about this as, you got your values, you got your money, you want to have a positive impact. How do you do it? You do it where all those Venn diagrams overlap. Now, this isn't just Joe Pelusi saying this. This isn't just something I made up. There is a long history of sustainable investing. It goes back to the Quakers when they, led by a disabled guy from outside of Philadelphia, a little person named Benjamin Lay, who is famous for convincing Benjamin Franklin that slavery was wrong. And then after that, he convinced the rest of the Quaker religion. And the Quakers were the first organization to divest from slavery way back in the day, way before the Civil War. Now, did that pay off immediately? Probably not. Did it pay off in the long term? Yeah, it did. If you go back and you look at economics, you would see economic history, you'll see that the wealthiest state in the United States when the Quakers divested was South Carolina. South Carolina, which, when I think of South Carolina, I think of deliverance. But in the day, South Carolina, because of the slave industry, because of the slave trade, and because of the ancillary industries that were enabled by that, South Carolina was the wealthiest and most powerful state in the United States. But it isn't now. And I think that speaks to long-term investments. Take morality and put it aside. Speak to long-term investments. If you take the long view, divesting can be a good thing. All right, so that's the Quakers. South Africa, similar deal. Divestment, from the apartheid regime in South Africa, eventually paid off. Now, US CIF, that stands for the United States Sustainable Investing Foundation. That's the trade group in the U.S. Again, it's not just, I'm not the only person out there who's doing this. There's a number of forward-thinking financial advisors and wealth managers who do this. My own personal intro into all this, like I didn't start with the Quakers. I started with Bill McKibben and his idea of divesting from fossil fuels. And then, like I said, I got some formal education in it, earning this CSRIC designation. So whether, if you do it yourself, that's great. If you hire a financial advisor, whether it's me or anybody else to help you with this, you want to look for that CSRIC designation. All right, now, let's talk investing. And let's show you some proof that you don't have to sacrifice returns to invest in a climate conscious way. So what I've shown here is I've shown one of the funds that I use for my clients, which is called the Amana Growth Institutional Fund. The ticker is AMIGX. It is a fossil fuel free fund. And yet, it has, over the long haul, outperformed the S&P 500, which, as you guys probably know, is like approximately the 500 biggest and most profitable companies in the United States. It is a famously good investment. So Warren Buffett once made a famous bet against a bunch of hedge fund guys, where he was like, okay, you guys pick whatever hedge fund you want, or multiple hedge funds, if that's what you want to do, and I'm going to invest in the S&P 500. And because we're all rich guys, we're going to bet $1 million a piece. And in 10 years, we're going to come back and we're going to see who made the most money. And Warren Buffett crushed all the hedge fund guys just by investing in the S&P 500. But what I'm showing you is you can do even better than that by investing in a fossil fuel free way if you do it intelligently. Why does it work? My opinion is there's a lot less risk in investing in fossil fuel free mutual funds. There's less regulatory risk, there's less transition risk, there's less reputational risk. Now, in our current environment, you can see that there's a maximum investing, that risk can only be transformed, it cannot be eliminated. And that is the truth. And so if you look at our current environment, you can see that, oh yeah, there might be less regulatory risk, but there's not zero regulatory risk. You put a Donald Trump administration in charge, and suddenly he's trying to bring back coal, and he is doing everything he can to help the fossil fuel industry in return for a substantial donation that they made when he was just a candidate. That being said, the one thing that does not change in my mind is the systemic risk. And here's one particular statistic, which says that a 1 degree Celsius increase in global temperature leads to a 12% decline in world GDP, primarily from all the extreme weather events. And if you look at what the German reinsurance executives are saying. So we're not talking about like, emotional Italian guys like me. We're talking about German insurance executives. They are predicting the decline and fall of capitalism based on climate change. And there was an article about it in The Guardian recently. Alan sent me a copy. I'd already seen it, but thank you, Alan. And anyway, the canary in the coal mine, to my mind, is really the reinsurance guys. They're like insurance without any regulation on top. They're pure insurance guys. Reinsurance means just in case you don't know, reinsurance is the insurance that insurance companies buy. And so, State Farm can't just jack up prices as much as it wants because the politicians in California want everybody in California to have access to insurance. So they put rules on how much, or Michigan or Pennsylvania, they put rules on how much an insurance company can increase premiums. But the reinsurance guys, there's no rules. There's just math. And those guys are the ones who are saying, yeah, I don't know if anybody's going to be able to afford what we're selling. The math is breaking down. Okay, you get the idea. I did want to show you in this idea of less risk. The example that I picked, demand of growth, you can see that it has 0% in $0 in fossil fuels. It has none of those top 200 carbon reserve companies, no coal, no oil and gas, no top 50 utilities, no fossil-fired utilities. So if humanity ever gets its act together and starts nationalizing and winding down the fossil fuel companies, which is probably what ought to happen, me and my clients and everybody else who owns a fund like Amount of Growth is going to go, meh, what do we care? We're not exposed to any of that risk. All right. Now, the flip side is when you stop investing in fossil fuel businesses, you got some extra money. You got to invest it somewhere. All the normal investment things apply, right? You want to invest in high quality businesses, hopefully that are solving real problems, hopefully climate problems. You got to buy low. Evaluations matter. And part of the secret sauce is that, honestly, despite all the propaganda, most people are good. And most people would rather work for companies that are doing good stuff than companies that are doing evil stuff, everything else being equal. And so, there was a very so my point is that these fossil fuel free companies can attract a higher quality of employee. And there are mutual funds. There was one, the guy retired. He started out, he was just a dude, and he retired a billionaire. And his secret sauce was he would invest in fossil fuel free companies. Okay, but there were some other funds that were doing that. But his secret sauce was he would combine that with an annual list of the top employers in America. I think it was a Fortune magazine survey of where do people really want to work. And not surprisingly, when you treat your employees well, they do a better job. Okay. And so if we look here again, going back to my growth, you can see that not only did it have 0% fossil fuels, but it's got 43% of its money invested in what we call the clean 200, which is sort of the opposite of the carbon majors. It's the 200 publicly traded companies that are making money with solutions in the transition to clean energy. All right. And again, this slide kind of has it all combined. So over 10 years, AMIGX outperformed the S&P by 1.31% a year. It's got less invested in fossil fuels, less loaned out to banks, less fossil fuel insurance companies, and more money invested in clean energy companies. All right, now, the other thing that I think is really important is shareholder advocacy. And the idea here is that when you own a piece of a company, you're an owner of the company in some small way. And if you own a big piece, if you are, for example, a mutual fund with trillions of dollars of assets under management, then you have a bigger voice. But not all the mutual fund companies approach that the same way. So one of the things that I look for with the companies that I invest in or the funds that I invest in is I want to see, are they using their power as shareholders? Are they using that in a positive, climate-friendly way? And I'll just to give you an example, Parnassus, which is a fund that I like, a company that I like. Last year, they voted in favor of 100% of all the climate change shareholder resolutions that came up. In contrast, Vanguard voted in favor of 0% of climate change friendly resolutions that came up. So there's a big difference. Are you investing your money with Parnassus, or are you investing it with Vanguard? And it's not just Parnassus and Vanguard. There are multiple fund companies that have very different approaches to shareholder advocacy. So this one that I really kind of like, this is my preferred real estate fund. It's called VERT, which, vertical. And they talk about influence through education. It's not just in voting, it's in engaging with corporate management, pushing them to do a better job, because it's in the long-term interest of corporate management, and the shareholders and the companies and everybody else on the planet. And they've gotten some results. And so if you compare, for example, VERT's real estate fund, which is the green one, to the benchmark real estate fund, right? So VERT's idea is to invest in sustainable, publicly traded real estate companies. It's got about 141 companies in its portfolio. The benchmark would be all the publicly traded real estate companies, 425. And my point is that the shareholder advocacy has had an impact. More VERT's companies are reporting their emissions. More importantly, more VERT's companies are reducing their emissions. And you can also look at that same thing on a percentage basis. So triple the emissions reductions per year. So I combine all that and I create my list of fund managers that I trust. They've got to be good on returns. They've got to be good on fees. They've got to be good on shareholder advocacy, and they've got to be fossil fuel free or as close as humanly possible. So I've got my list of fund managers that I trust. Amana, Parnassus, Brown Advisory, Calvert. Calvert's good on bonds. Wellington, based out of Boston, working with MIT, good people. VERT, Bailey Gifford, based out of Scotland, good international funds. And then there's some other ones that, the jury's kind of out. Amundi's got some good bond funds, I think. They're definitely sustainable. I'm still testing out whether they've got good returns. iShares is a giant company that's all over the map. Some of their funds are okay, some are not. GMO, anyway, you can see the list. But the point is that the way I approach this is you've got a short list of people that you trust. You're open to new ideas, and then you're very skeptical of everybody else. You can also look at this through the lens of asset classes. Not everything you might want to invest in has a sustainable option that's a good option. A lot of them do, but not all, right? So in my opinion, American equities, bonds, foreign developed equities and bonds, foreign developed equities and global bonds, emerging market equities, Ethereum. Now, cryptocurrency, very controversial, but it's not all the same. Bitcoin is extremely energy intensive. Ethereum is 97% less energy intensive. So if you do want to speculate in crypto, I recommend Ethereum, not Bitcoin. And I really don't recommend anything besides, like, I wouldn't even consider the other stuff. It's mostly a pump and dump scam. Okay. Now, when I say without good sustainable options, that's my opinion as of the current moment. Things are always changing, but at the moment, I don't have any foreign developed bonds, emerging market bonds, commodities. Commodities are the bane of my existence. I'd love to invest in them, but they're so heavily in oil, you can't do it. Trend following funds, Bitcoin, conventional energy funds. My opinion, you want to avoid these things. And then there's this other category where it might be 100% sustainable, but it's just too risky. And here I'm talking about individual companies, individual bonds, except treasury bonds, but even then in a Trump administration. But historically, the United States government has never yet defaulted on its bonds. Fingers crossed that remains the case over the next 4 years. Yeah, exactly. and sector funds. I might change this. Maybe I should move sector funds to. There are a couple, like there's some sector funds. There's one that I like that invests in the technology sector. It's 100% fossil fuel free. It's got like 400 different tech funds. Is that diversified enough? Maybe. I would talk that over with a client and see what they wanted to do. Okay, asset allocation is the name of the game. You need a diversified asset allocation model. That means, I talked to a guy one time who said, Joe, I'm diversified. I own 20 different cryptocurrencies. He was like, dude, you are not diversified. And the same thing is true in other things as well. So if you own 20 different domestic American large cap funds, A, that'd be weird, but B, you wouldn't really be diversified, even though you might have hundreds of different companies. They're all highly correlated. They all move in the same direction at the same time. That is not, to my mind, meaningful diversification. So I like an asset allocation model. It's got a little bit of peer review. Hopefully somebody's triple checked it. Hopefully this is important, hopefully there are assets for different economic conditions. Equities do well when things are good. Bonds generally do well when things are bad. And when interest rates are going down. And gold does well when nobody knows what the heck is happening. Not surprisingly, gold is doing better now than it's done since the 1970s. I also like to kind of double check it. So my asset allocation model got something for everything. And then on top of that, we try to look for a signal through the noise. And the signal that I like is if unemployment's going up and the US stock market's going down, that's probably a bad sign. And in that scenario, I'm going to increase my bonds and decrease my equities for my clients. And then you can kind of play, also you need an asset allocation model where everything has sustainable alternatives. If your model is telling you to put a lot of money in commodities, well, there aren't really any sustainable commodities funds, in my opinion. That's probably not a great asset allocation model for you, for a sustainable investor. So here's sort of a general example. You might have, if you were a moderate risk appetite investor with a moderately long time frame, you might, as a base, have 50% of your money in equities. Maybe you divide it between a core equities fund and a growth equities fund. You might have 25% in bonds. That'd be the IEF. You might have 25% in gold. If you're more aggressive, let's say you're younger and you get a good job and you're not going to touch your investments for 30 years, maybe you still have the same types of assets, but you play with the percentages. Maybe you have more in equities and less in gold and bonds. If you're more conservative, for whatever reason, maybe because you're older, maybe because you're retired, maybe because you need to be drawing down your investment portfolio, maybe you have a lot more in bonds and gold and a lot less in equities. But you should always have some money in equities, some money in gold, some money in bonds, my opinion, because they're not correlated. They move in different ways at different times in response to different influences. Now, another way to look at this, you can look at it as private versus public investment. Private investment, your money is going to put something into the world that didn't exist until you invested in it. So, for example, I've got some of my clients in a sustainable infrastructure fund. It is because of their money, massive amounts of solar panels are out in the world that wouldn't be there without their money. I've got other clients. I've got some of the same clients in both, including myself, in a sustainable housing fund. So now, there's a LEED Gold certified apartment building that exists that wouldn't exist if we didn't invest in it. Private equity, same deal. You gotta look real hard at private equity. Most of those guys are not good people, but there's a couple that are. And I've found at least one good private equity fund that invests in a sustainable way. And then similarly, if you want to invest in venture capital, it's risky, but you can be bringing whole new types of companies into the world that might not exist. And that can be done. There are VC funds that specialize in climate solutions. I like them. All right, and then the public is the main thing we talked about. This is open to everybody. Shareholder advocacy is key. Bonuses, by this I mean, when we don't invest in the fossil fuel companies, their stock price goes down. And as a result, the bonuses of their evil corporate executives that are tied to their stock price goes down. And I like that. Cost of capital, their cost of money to borrow money goes up. I like that as well. But then also green bonds, I think are a good deal. You're loaning money to municipalities or to companies, and they're going to take that money and they're going to do something sustainable with it. Maybe they're going to invest in solar. Maybe they're going to phase out a gas-powered power plant. Maybe they're going to improve the water purification system, the water filtration system. They're going to do something sustainable with the money you're loaning to them. Positive impact. I wanted to give you a concrete example of a renewable infrastructure fund that I invest in. And I wanted to point out with the private investments, the main risk is liquidity, or sort of the main differentiator. Meaning when you invest in something like this, you can't sell it tomorrow. It's not on the New York Stock Exchange. You put your money in, you cross your fingers, in 5 years, hopefully you get a nice return on your investment. And it might be a nice return. It might be 12 to 14%. But you're going to have to kick in a fairly substantial minimum. And this sort of stuff is only available, it's not available to everybody. Unfortunately, in my mind, unfortunately, you've got to have a certain amount of money, either in assets or income, to be considered an accredited investor and therefore eligible to invest in something like this. And there are other private market investments where you need to have even more money and you've got to be a qualified investor. So, it's not available to everybody, but for those who can afford it, it's a nice diversifier, and I think you have a big impact. All right, what if you're an employee? You might be like, Joe, I can't do everything. It's not up to me. There's a 401k. There might be a mutual fund window that has more sustainable options, or maybe you can push your employer to offer a sustainable 401k. They do exist. So, don't let anybody tell you it's not possible. You can find somebody like me or somebody else to help you do all this stuff. And then finally, community, and you guys know this, Kalamazoo Crisis Coalition, but community is important. That's the only way we get through this crisis, in my opinion. Here's some examples of communities that I'm a part of, including the Climate Change Book Club, that I find valuable. Here's my mandatory disclaimer. Investing involves the risk of loss, including the loss of principal. I have not considered your individual financial situation. Therefore, everything I've said should be considered general education and not financial advice. Don't sue me. Here are some resources. Here's a great quote from the Ministry for the Future, which is, I see all of this as, going long. You don't want to short civilization. Even if you short civilization, you might make some money, but how are you going to enjoy it? Are there any questions? I know I talk too much. I love talking about this stuff. Sorry, guys. But if there's any questions, and there's any time, feel free to ask. Yes, there's a question. A question from Crystal York.
Hello. Yes, that's me. I am, I was gonna ask a question about, yeah, the employer fund since my employer uses Vanguard as the investment management company. So you kind of answered my question there, but any more comments on that would be useful. My other question is, I've heard that sometimes with the green mutual funds or ESG or whatever it's called, sometimes a lot of times the fees are higher and that'll eat into your returns. So yeah, any comments on either of those things would be useful for me as I am a young person just starting out.
So I have comments on both. First of all, I should point out that Vanguard has many, many funds, and it has some that are what they call sub-advised, where the actual investment decisions are not made by Vanguard, but by some other manager that Vanguard has hired for its particular expertise. And so there is at least one Vanguard global ESG fund that is sub-advised by Wellington out of Boston that is legit. They have excellent returns and they are legitimately green. And I sometimes wonder that if Vanguard realizes that that fund is even in its lineup, but for the moment, it's available. Now, your other question regarding fees. So I think you gotta pick your poison. You gotta make your bet. What I like to do is I like to look at the difference in the cost and compare it to the difference in performance. And so, yes, you will pay a little bit more. If over the long haul, you are earning a lot more in return, to me, it is worth it. But you got to make up your own mind about that. Hopefully that answers your question. Susan Schneider, please ask your question.
Okay, your resources slide was only up very briefly, Joe. I don't know if we want to see that again. Of course, it'll be in the recording. I'm wondering too about any books you might recommend for people who don't want to invest sustainably.
Good question.
Okay, good.
Books is a good question. There's nothing that I really love. There's a lot of sustainable investment books. That's right. There's a few sustainable investment books. Nothing I love. Sorry.
Okay, thank you.
You're welcome.
You got a right one.
Maybe, yeah. Mark.
Thank you for a wonderful talk filled with useful information for me. I think I'd like to raise a personal question, but only because I think my situation may be shared by several people here in this audience, just looking around. I'm kind of locked up with TIAA. And that means that my IRAs and Roths at least have a narrow range of possible investments. I can establish a brokerage window into some of the accounts types, but not others. And that allows me to go beyond that. But I had a good solid chunk in TIAA Social Choice Low Carbon Fund. And then they changed the name about 3 months back to Nuveen Large Cap Responsible Equity Fund. And I haven't done the analysis yet. I mean to, but I keep getting distracted. To sit down and say, okay, did that change of name, dropping the low carbon, actually correspond to a change or a dilution or a elimination of that value? Do you happen to know anything about that, or just maybe similar, anything you'd like to comment on for people like me who are don't have a big brokerage account that we can invest in anything?
Yeah, my comment would be thank God you're locked in with TIAA. They're not too bad. If you're gonna be stuck somewhere, that's a reasonable place to be stuck. They, TIAA stands for like teachers, insurance, something or other. But what's important is that they started out with a lot of teachers. And I think because of that, they have a little bit of sustainability in their DNA. And so that I am not 100% sure, but I'm like 85% sure that the specific fund that you're talking about remains a good fund. There's definitely a new large cap fund that I have on my short list of funds that have performed well and are genuinely green. And I think it might be the one you're talking about. Although, you should double check. But I guess my gist is that in Nuveen, in TIAA, you can find some reasonable options. So I think you should be okay.
Okay, thanks.
You're welcome. Tom.
Okay, thanks, Joe. I just want to reiterate what Susan said. I was going to take a screenshot of your resource page, and then it went away so quickly I missed it. But my church is currently reevaluating its investment advisors, and we don't have a huge endowment fund, but we have one that we want to protect, and there is some interest in doing something in ESG funds. And I'm wondering if there is different advice you would have for an institutional investor as opposed to personal.
No, my thought, and then in terms of institutional versus individual, no, the only difference is the risk tolerance. So, an institution is going to have its own risk tolerance. It's probably going to be more conservative than that of a 25-year-old kid, but maybe it'd be less conservative than that of my 75-year-old mother. I don't know. So you got to figure out, the right asset allocation model or the liquidity, the risk tolerance of the institution. But the general point is there are definitely sustainable options. There's enough sustainable options in enough different asset classes that, so for example, the Sustainable Business Network of Philadelphia is also a nonprofit. It also has money. We invest that in a sustainable way. It's totally doable.
Okay.
Alan.
Yeah. Well, first, I just want to say thanks a ton. It's really helpful to have you come and talk with us, and I really appreciate the way you approach this with a general, some general lenses and fundamental ideas to think about, and of course the framework you put it in, was great. And I know I need to do work more in this direction, and that was one of the two things I wanted to say. The other thing I wanted to say was I also wanted to ask about TIA, and I think that one thing that I and some other faculty have been talking about is trying to get TIA to come and talk with us about sustainable developing. I know that their general, sustainable fund. They don't call them they don't call them sustainable. They call them social justice funds are have a pretty good reputation. But I haven't seen the kind of analysis, particularly of the question of how green they are and so forth. But yeah, we can, Mark and I and others can continue to think about that, work on that.
Yeah, I would just say that TIAA was acquired by Nuveen, and they're now a pretty big asset management company with a variety of different funds, some of which are sustainable and also perform well. some of which are not sustainable at all. Some of them are sustainable but don't perform well. You got to kind of drill down into the details.
Okay. I have a question now. I don't see any other hand raised.
Yes, Nikki.
Yeah, I was reading an article about how a consortium of bankers or banks, including JP Morgan, Bank of America, et cetera, have decided rightfully that we're going to just blow past 2 degrees and head towards 3 degrees. They still are up in the air as to how long this is going to take, but they basically decided that we blew it and we're going to end up at least 3 degrees. So when this happens, when the banks are in agreement that we're in dire straits, how do you start investing for that kind of a future? We have no, I mean, we've hit the 1.5 well before anybody was expecting we're going to. We're going to hit the 2 very quickly, probably 5 years at the rate we're going of 0.1 every year. And so how do you really start investing for something along those lines?
So I'm going to push back just a little bit, and I'm going to say that my understanding is that some of these finance people, in particular the reinsurance people, are saying that we are on a projection, we are on a path that if we don't do anything better, we're going to hit 3 degrees warmer. And at that point, it's sort of like when a hurricane is bearing down on the Jersey Shore, and at a certain point, it's going to hit. And if you're not out of town by that point, you might as well have a party. But we're not there yet. We're in a regime right now that's run by corrupt, unintelligent, short-sighted people. And they're doing everything they can to keep us on a 3 degrees or worse pathway, but nothing's set in stone yet. Right now we're at 1.5, and that's not great. That's pretty bad. Talk to people in Asheville, talk to people in Pacific Palisades, et cetera, et cetera. But that's not 3. And I'm not ready to throw in the towel yet, and so therefore I'm still investing my money, and I'm not just out there spending it and partying.
Okay, I have a question from online, then Crystal, okay?
Yes.
The online one is, do you have expertise on angels/VCs investing in DAC companies? Thanks for a great session. So.
I was nodding my head right up until you said DAC. I don't quite know what DAC stands for.
I'm sorry, I was just reading the question.
It might mean direct air capture.
Yes. Okay, that makes sense. So I have expertise in angel and VC investing, which is hard-earned expertise. And I will just say that there are 2 flavors of venture capital and angel investing that are relevant here. There's one that is what you might call sort of general impact investing with a climate lens. And the other is more deep tech, hard science, hard problems, different ways of saying it. But there are some VC funds that are really technologically focused, and they are like, we're going to invest in the cutting edge technology that might not come to market for many years, may or may not actually work. If it does work, may or may not work at scale. From a pure finance perspective, those are riskier bets. And so the returns in those funds have not been great. I myself lean towards a fund that mitigates and kind of spreads it around. And so the VC fund that I like does some hard science, but not 100% hard science. And as a result, has had a better track record. Again, not my money, it's the client's money. And so, with my clients, I talk that stuff over. But I guess those are my thoughts, that it exists. You can invest in it. Some of them, you better have a ton of money. Like some of these VC funds, $500,000 minimum investment just for the fund itself. That's not everybody. And again, I've put some work into finding funds with lower minimums that are accessible to more people. But that's my 2 cents. Crystal, back to you.
Hello. So let's say like moving forward, I do want to start investing in these funds, but in the past, I've already been investing in general, like low cost index funds, hadn't really thought about it. Do you suggest any like money transfer? I know there's like maybe tax implications or other implications for taking money out and now investing in a different place. Yeah, just any comments on that.
Yeah. So what I would say is, in an ideal world, especially somebody your age, just looking at you, in an ideal world, your money is invested in a retirement fund, whether that's an IRA or a 401k. And in that situation, you can change all your investments tomorrow and there are no tax implications. And therefore, you should change all your investments tomorrow. If you're in a what I always think of as an individual non-retirement fund, then there are going to be tax implications, and then you're going to want to do that intelligently. You're going to want to take long-term capital gains, not short-term, because you pay it at a lower rate. And even then, a conversation needs to be had between you and me, or you and yourself. You got to think through. When do I want to pay these taxes? And do I want to do it all at once, or do I want to spread it out? Reasonable mind can defer on that.
Okay. Yeah, I've really only done IRA and 401k, so.
Beautiful. You're good. You can change everything. Tim, one more.
I'm wondering about how I can describe this event as not necessarily representing a recommendation for a particular service or business from KCCC.
The way it's generally done is people say something to the effect of, and it's in my slide, something to the effect of, because we haven't considered anybody's individual financial situation, this is not financial advice. It's just general education about investing. Now, every time I hear that, I kind of like roll my eyes a little bit, but there it is. And I think it is true. Like I don't know everybody's individual situation, and you don't know mine. And so I think as an organization, you can say, this guy came in, this is what he said. We can't really vouch for the guy, but if you want to listen to what he said and make up your own mind about it, go ahead. You're welcome.
I have an additional question, if I can figure out how to ask it.
Yes, ma'am.
Crystal brought up funds, and you said, IRAs, the rollovers, and most young people working are putting their money into some sort of employer fund, like the TIAA, or I had a 401k. I had really no say in where my money was going. It just, they invested it however they did. So there are some, you might call them investment clubs, where people put like $100 into something. So to get into what you're talking about, the mutual funds, the amount of holding, are there minimums that people have to be concerned about? How, if you're a young person, you're starting out in life, you want to put money away so that you can then take it out if you want to buy a house, if you want to, when you have kids, whatever. Are there any kind of penalties with what you're talking about?
So, you would want to look at the individual fund, but many of them, Amana might be one of them. I think it is, but don't quote me on it. Many of them really are true believers, and they want to make their funds as accessible as possible. And so many of them literally have a $1 minimum investment. And many of the others that don't still have fairly reasonable, fairly low minimums. That's that point. And then number two is with regard to the 401k, there was a study recently, the amount of money that is going to fossil fuel companies that is hidden in what appear to be vanilla index funds is massive. And the amount of return on investment that's left on the table because of that is also not insignificant. And so it is in both the world's interest and the interest of the employees of these 401ks to shift their money in a more sustainable way. And because of all that, there are startups that specialize in creating low-cost, sustainable index funds that are appealing to employers that are offering retirement plans, whether it's 401k for the private industry or like 403b for public sector, et cetera. So there are options here. And if you're talking to a younger person, you should tell them that although, HR might tell you there's nothing they can do, there's something they can do.
Okay. David, last question.
Yeah.
Thank you very much, Joe. I'm almost certain I will watch your presentation again because there was some information in there that I wasn't able to jot down. I have a question that's actually not something you addressed at all, and maybe not something you can answer, but it's a big question on my mind. Everybody that attended this and you are here because we want to do something to help slow climate change, right? So all of the options that you've talked about are, if we invest, here's how we should think, here's how we should decide what our investment should be. Another alternative is simply donate to groups that are trying to take some tangible action right now. And so my question is, do you have any idea how much good we would do by investing a certain amount in responsible funds, or versus giving the money to an organization that's trying to do something direct? Do you have any idea what the ratio of good done by our money would be in those two alternatives?
So my honest answer is I don't. I would say that what we're doing thus far as a human race is not working all that great. Emissions go up every year, temperature goes up every year, extreme weather and consequent suffering and misery goes up every year. So to my mind, that means we don't have the answer. There's no like the correct answer. There's throwing stuff at the wall and hoping something sticks. And so to me, investing is something reasonable, and so is charitable donation. I don't see it as an either or. I see it as a both. And then on top of that, you still got to live. Like you as a human being, me as a human being, like we all still gotta. My kid needs to have money to retire on when she is older, and so if she gives it all away to charity, if nothing else, it's not going to be great for her. And so again, I think, unfortunately, and I'm not a particularly moderate person, but unfortunately, I think moderation is key here, and diversification. And so I give some money away and I invest some money. Yes, Susan.
Yeah, just I'm wondering, Dave, were you referring to the model where you can contribute to a nonprofit that's working on climate change and they give you money back? And I'm not sure what that's called, but so you still have an income from it, but it's part of the endowment of the organization, and again, because I get, I donate to nonprofits, and so then they send you information about how to do this, and I haven't done it yet, but maybe some of you have. But was that what you were referring to also,
It isn't.
Dave?
Yeah, Susan,
Okay.
I'd never heard of it till just now. Just
Oh,
this
really?
second.
Yeah. Okay.
Yeah.
'Cause
So
it's-
it wasn't. I was just thinking of how to make your money do the most overall good.
And there's a
And
whole movement about this called effective altruism. And unfortunately, sometimes it's been kind of co-opted. But I think it's a reasonable question. You want your money to do the most good. It's not all, not everything is equal. But I think in my mind, and I'm no expert on it, but in my mind, I want to diversify my attempt to do good.
Yep.
Okay.
thank
Well,
you.
All
thank
right,
you,
guys.
Joe.
Well, thank you, Joe.
Yeah,
Very
thank
much.
you. Thanks for having me. Thank you. Take care,
Thank you.
everybody. Talk to you soon.
Thank you, Joe.
Thanks,
Well,
Joe.